The White House's tough tariff stance triggered a sharp sell-off in risk assets, but surprisingly, gold didn't rise from the very beginning, it dropped. What's driving this unexpected move? And with both China and the US standing firm on tariffs, safe haven buying is making a comeback. Could this mean the path higher for gold is back on track? All that and more in this episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Gold unexpectedly pulled back over the past week. Two key factors seem to drive the sell-off from my personal perspective. One would be profit-taking after the US tariff announcement, and the second one would be forced liquidations triggered by the sharp drop in risk assets. But with the clock ticking down on different tariff hikes from both China and the US, renewed geopolitical tensions are now drawing safe haven buyers back into gold. This week, whether Washington can make any meaningful progress on trade talks, especially with China, will be quite crucial. Plus, tonight's US CPI print could trigger some short-term price swings. Looking at the gold against US dollar daily chart, we saw a sharp retreat from all-time highs by yesterday's close. Since last Thursday, gold has broken below both the 20-day moving average and the $3,000 level, at one point falling nearly 6.6%. However, bears run into strong buying pressure near $29.50, a level that coincides with both the late February local top and the 38.2% Fibonacci retracement of the December to April rally. After the intense back and forth on Tuesday, bulls managed to lift prices back above $3,000 as of recording. If we see a clear break above the 20-day moving average, it could confirm the upside momentum. While on the downside, $29.50 is shaping up as key support. Well, I know that many had expected gold to surge alongside a risk-off sentiment triggered by the US aggressive tariff stance, but the opposite just happened. In my view, there are two likely factors for this pullback. First, it would simply be profit-taking after a wave of safe haven buying. Yes, Trump's tariff plans were more aggressive than expected, but they also removed some uncertainty by clearly laying out who's being taxed and at what rate, also when. That kind of clarity may have led early buyers to lock in profits, especially since gold wasn't explicitly mentioned in the White House statement. Second, we may be seeing margin-related selling. With risk assets under pressure, some investors might have been forced to liquidate gold positions to meet margin calls elsewhere. That said, I still believe gold's broader trend remains to the upside. Trump, just let the tariffs roll out without saying anything, which means China may take more aggressive countermeasures. Risk-off sentiment has already pushed the 10-year US Treasury yield to a 4.5% high, and trade tensions are continuing to escalate. In addition, the March US jobs report showed strong payroll growth of 228,000, well above forecast, but the unemployment rate ticked up to 4.2%. That signals potential cracks in the labor market, especially as the full impact of tariffs and immigration policies hasn't played out yet. With 104% tariffs possibly pushing US inflation closer to 4%, recession risks are rising. In response, markets have increased rate cut bets for the Fed this year from 2 to 4, pricing in over a 50% chance of a downturn. That's a tailwind for gold as a safe haven asset, obviously. And even though Trump is calling for rate cuts, the Fed hasn't really sent any clear signals of easing and is likely to keep rates steady until the June meeting. With nominal rates unchanged and the inflation expectations rising, real yield could remain quite low, which is typically bullish for gold. And in the medium to long term, I also see gold as a strong portfolio diversifier amid mounting global recession fears. Once the liquidity stress eases, that should favor the bulls. Central bank gold buying driven by concerns over US credit risk also remains a key tailwind. And with the Fed sticking to its rate cut path, falling nominal and real yields will continue to support non-yielding assets like gold. So oil gold has pulled back in the wake of the tit for tat tariff announcement, but the downside has been fairly limited, and we've already witnessed a rebound. The harsher than expected US tariff response sparked fears of a global slowdown, which spilled over into gold. Safe haven demand and central bank buying also keep gold in the spotlight. Looking ahead, whether the US and China can strike a deal will be the key focus. With sentiment already quite fragile, markets could react quickly to any signs of de-escalation. A breakthrough in talks could calm nerves and weigh on gold, while any signs of rising tensions might reopen the door to further upside. Also, keep in mind that the latest US CPI data won't yet reflect the impact of new tariffs. If the March report shows another inflation surprise to the upside, traders may trim some rate cut bets, which would slightly pressure gold. Then again, if the stagflation narrative gains traction, we might see safe haven flows return. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming data events might impact gold trading, drop a comment below and let's discuss. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!